Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next 20 minutes or so talking to you about the COVID-19 pandemic and the impact that it's having on the global economy and investment markets. I'd also like to share some thoughts with you about Adviceworx' view on the current investment climate and prospects for the rest of the year. The Chinese Communist Party celebrated its centenary on Thursday with a massive parade on Beijing's Tiananmen Square. President Xi Jinping addressed the crowd from the same balcony on which Mao Zedong announced the founding of the People's Republic in 1949 and warned that China would never again be bullied by foreign forces. He also vowed that China would do whatever it took to achieve reunification with Taiwan and stamp out anti-communist resistance in Hong Kong. Xi celebrated China's rejuvenation as a great power, but made no mention of episodes like the Great Famine, the Cultural Revolution, or the crushing of the student protests in 1989. By Friday night, nearly 184 million people had been infected with COVID-19 worldwide, and just under 4 million people had succumbed to the virus. The United States remains hardest hit, with 34.6 million infections and over 621,000 deaths. India, Brazil, France, and Russia make up the rest of the top 5, and South Africa remains in 19th position in terms of the most recorded cases. The number of new COVID cases reported worldwide this week was 90,000, or 3% higher than last week. Brazil and India experienced significant reductions in weekly new infections, but there were sharp increases in other large nations like Indonesia, Russia, and Bangladesh. A major concern is that the highly contagious Delta variant is capable of infecting people who are either vaccinated or have recovered from earlier infections. This has caused a resurgence of infections in countries that had seemed out of danger, like Britain, the United States, and Spain. The weekly global death toll was 1,900, or 6% lower than last week. Given that deaths lag new infections by 2 to 3 weeks, this is cold comfort. Brazil and India were largely responsible for this reduction, while Russia, Indonesia, and South Africa saw sharp increases in fatalities. As of Friday night, 3.1 billion doses of vaccine had been administered worldwide, of which nearly 1.3 billion occurred in China, 335 million in India, and 328 million in the United States. 1.85 billion people, or 24% of the world's population, had received at least one dose of vaccine, and around 40 million doses were being administered per day. Based on assumptions about China, which does not provide these statistics, about 1.6 billion people, or 22% of the world's population, are now fully vaccinated. An estimated 600 million of them are Chinese, 156 million Americans, and 60 million Indians. Central bankers remain adamant that inflation will not become a long-term problem, and the US economy keeps on creating new jobs. European manufacturers are more bullish than ever, but their Chinese counterparts are slowing down. US Treasury Secretary Janet Yellen has obtained widespread support for her proposed global minimum corporate tax plan, and the Pacific Northwest suffered through its worst heat wave in recorded history. The US Federal Reserve may well be right about rising inflation. Consumer price inflation, the blue line, and core inflation, the green line, have both risen significantly in recent months, but in effect both have merely been making up lost ground. We have to remember that inflation fell sharply with the onset of the pandemic, which caused price levels to lag behind where they would have been if prices had just kept increasing at a steady rate of 2% per annum over the past 2 years. As we saw in the previous slide, the acceleration in the US inflation rate is largely a function of last year's slump, which lowered the base against which today's inflation is measured. There is therefore good reason to expect the inflation rate to moderate now that last year's lowest points are more than 12 months behind us. Nevertheless, economists warn, the massive amounts of cheap money sloshing around in the system should result in inflation stabilizing at a level about half a percentage point higher than before the pandemic. The sharp rise in fuel prices has been one of the key drivers of inflation since the latter part of last year, with supply relatively stable while demand grew. One element of demand which has yet to reach its pre-pandemic levels is that for aviation fuel. The airline industry is one of the world's biggest consumers of petroleum products, but it has been constrained by lockdowns. In Europe, flights are at around 40% of their pre-pandemic levels, and in America and China at 75 to 80%. Expect strong upward pressure on the oil price when things get back to normal. US equities, particularly technology and bank stocks, rallied strongly this week, and Facebook and Microsoft passed major milestones. The strong US job numbers caused bond yields to rise and the dollar to strengthen, while gold tread water. Bank of America warned that the oil price could rise by a third, even as Volkswagen announced that it will stop making vehicles with internal combustion engines. Tesla is losing face in China over hyperactive autopilots in its cars. Wall Street and the Taipei Exchange in Taiwan had strong weeks, but China's stock markets were not as jubilant as the government during Centenary Week. The Nasdaq was the best performing major index over the past month, and the A50 the worst. For the year to date, Taiwan's weighted index is now first and the A50 last. Over 1 year, the Russell 2000 heads the pack, with Hong Kong's Hang Seng bringing up the rear, and over 3 years, the Nasdaq and the FTSE, respectively. The stronger dollar weighed on commodity markets this week, with a few notable exceptions. Oil ended the week lower, but the prices of cobalt, coal, and palladium rose strongly. Among the week's losers were nickel, platinum, and copper. Over the past month, coal, lithium, and cobalt fared the best, while platinum and copper were the laggards. For the year to date, lithium is still well ahead of the pack, with gold still well underwater. These two tables depict just how dominant the technology sector has become on global equity markets. 5 of the 10 most valuable shares belong to the sector, while Amazon and Alibaba, who are officially classified as consumer stocks, are essentially also technology-driven. Tesla also has a technology bias. Pure technology shares make up a third of the global top 100's market capitalization and 1/5 of the companies represented in it. By contrast, only 2 commodity producers currently make it into the top 100. We remain positive about global equities. Corporate earnings continue to grow in the current low interest rate environment. US price-to-earnings ratios are looking stretched, but equity earnings yields remain more attractive than bond yields. Pan-Europe offers better value, but the most attractive valuations are to be found in Japan and emerging markets, including China. We are, however, keeping an eye on what happens to inflation and interest rates and will react if they take a turn for the worse. For now, we remain underweight global bonds as yields remain unattractive, and if mandated to invest in bonds, we prefer emerging market bonds over those of developed markets. We retain a neutral weighting with regard to global property. Our least favored sectors are retail and office property because e-commerce and work from home could do long-term damage to their profitability. Conversely, these two trends are positive for the industrial and residential property sectors. The hospitality sector should recover in due course, but only once vaccinations have achieved critical mass. When the first COVID wave hit South Africa in March last year, our government imposed some of the strictest lockdown measures on earth. As part of its antivirus campaign, it erected a number of large, expensive field hospitals like this one at Nasrec in the south of Johannesburg. South Africa is currently battling a far bigger third wave, with our hospitals overflowing due to the highly virulent Delta variant. And yet, despite patients having to be moved from Gauteng to other provinces for lack of hospital beds, government has given no indication that it intends to utilize these expensive white elephants. More than 2 million South Africans have now tested positive for COVID-19, and our country is enduring one of the world's fastest growing numbers of new cases per day. On Friday, 303 more people succumbed to the virus, which brought the death toll to date to 61,332. Gauteng is now unquestionably the epicenter of the pandemic, with the most active cases and the highest death toll. Just under 3.3 million doses of vaccine have thus far been administered, and sadly there are many people who are eligible for vaccination who refuse to have it. Former President Jacob Zuma has been sentenced to 15 months imprisonment for holding the State Capture Commission in contempt, but his followers have vowed to resist any attempt to arrest him. The economy shed more jobs in the first quarter, and the new lockdown will no doubt exacerbate the state of affairs. Thanks to subdued imports and strong commodity prices, South Africa achieved another huge trade surplus in May, and businessmen are more confident about the future than consumers. Government claims it has no more money for COVID relief allowances, and Eskom has admitted that it is cash flow negative. This graph depicts consumer confidence in South Africa over the past 7 quarters, split between income groups. In the second quarter of this year, low-income earners were by far the least confident about the future, followed by high-income earners. This should not come as a surprise. The poor and low-skilled have borne the brunt of job losses and income reduction, while high-income earners are often business owners and professionals whose revenues were hit. The middle income category consists mostly of government employees and unionized workers, whose jobs and incomes were generally not affected materially. There was some good news for the hard-pressed consumer this week. After rising sharply in the recent past, the prices of white maize, the dark blue line, yellow maize, the grey dotted line, and wheat, the green line, are starting to reach a plateau. Over time, this should result in more subdued food price inflation, since white maize is a staple for millions of South Africans, yellow maize is our main livestock feed, and wheat is the basis of our daily bread and pasta. The JSE ended the week flat, with industrials and resources up and financials down. The hospitality and tourism sectors face further headwinds, and the bond market was volatile while the rand ended weaker. The pandemic has devalued listed property portfolios, and Rio Tinto has declared force majeure in Richards Bay. Aspen will soon be producing COVID vaccines in Gqeberha. Glencore is still interested in mining coal, and FirstRand and Investec are coming to Cell C's rescue. Last week, foreigners were net sellers of South African securities again. The JSE saw an outflow of 7.5 billion rand, while the bond exchange suffered a loss of 6.1 billion rand. For the year to date, the outflow from the JSE is now around 37.6 billion rand, and for the bond exchange, the number is 41.15 billion rand. South Africans have long been arch pessimists when it comes to the value of their currency, the rand. This is entirely understandable, as the local currency has been depreciating at a rate of roughly 7% per annum against the dollar for a number of decades. Over the short to medium term, however, the rand often surprises to the upside for a year or two. We are currently in the midst of one of these episodes. For the past year, the rand has consistently outperformed the emerging market currency index. Although several other emerging markets have also participated in the current commodities boom, they haven't recorded the massive trade surpluses that we have because South Africa's weak domestic economy has kept our imports extremely low by international standards. This infographic depicts the relative performance of the JSE's 3 macro sectors over the past 6 months on the left and 12 months on the right. Over 6 months, the Resources Index, the dark blue bar, has marginally outperformed the Industrial Index, the orange bar, while the Financial Index, the light green bar, lagged them by nearly 2 percentage points. Over 12 months, on the other hand, financials returned 33.4% compared to the 28.4% for resources and a modest 17.1% for industrials. We remain slightly underweight South African equities relative to our long-term strategic asset allocation. Domestic equities look cheap relative to offshore equities, both in developed markets and emerging markets, as well as relative to the JSE's own historical average price-to-earnings ratio. Despite the apparent value they offer, local equities remain hamstrung by the weak domestic economy and uncertainty over government's economic policy intentions. Despite the sharp recovery in the prices of some domestic listed property counters, we remain worried over the sector's long-term outlook and heavy debt burden. We therefore avoid property until the outlook changes materially. Domestic bonds remain our preferred local asset class. Yields remain highly attractive, and although we remain concerned over the long-term outlook for South Africa's government finances, we believe that a substantial risk premium is already factored into bond prices and yields. We prefer government inflation-linked bonds at the shorter end of the yield curve and nominal bonds higher up the curve. We are wary of corporate credit, however. It looks both risky and expensive. The Adviceworx asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make at least some sense of it. Should you have any further queries or questions, please don't hesitate to contact me or your Adviceworx financial advisor. All the best for the week ahead. Goodbye from me.